Welcome to today's Merk webinar. Our topic today is on the portfolio implications of tariffs. On today's call, we have Merk's President and Chief Investment Officer, Axel Merk, and myself, Financial Analyst David Song. At the end of today's presentation, we will have a Q&A. As always, we do encourage questions from the audience, so please feel free to ask a question at any point during our presentation by typing it into the questions box on your screen. Now for some announcements. Next month is our quarterly webinar. We will send an email reminder on that, so stay tuned. This presentation will be recorded, and with that, I will now turn the call over to Axel to begin the presentation. Axel?
Yes, thank you, and welcome everybody. As you might be able to gauge, we're using a different platform to broadcast our webinar, so you see my pretty picture, and give us feedback of what things work, what things don't work, and so forth. But to today's webinar, obviously the topic is hot on everybody's mind with the tariffs on China just being announced earlier today and the wonderful reaction of the stock market with the Dow Jones plunging more than 700 points. The goal here today is to go in some ways into the tariffs a little bit, but then take it a step further and talk about politics and investing. How much should we pay attention to the political noise? How much should we pay attention to the tariffs? And do they have a market impact? Well, if you look at today's market reaction, and if you attribute that to the tariffs against China, then by all means you should. But maybe, who knows, maybe it's just a journalist or lots of journalists trying to link the two. So we'll tap into that a little bit. And we have this wonderful cartoon here that we created quite early, obviously, in the Trump administration already. And to kind of put this into context, many people have strong emotions when it comes to our administration, to our president, and this is not a first. When anybody else has been president in the past, we have emotions. We may agree or disagree, historic with a guy or with a gal, maybe one day in the future. And so part of the question is, well, does it matter? Should we pay attention to it? Should we not pay attention to it? And then more specifically, of course, with regard to the tariffs, what are the implications for the portfolio? How does it affect the assessment of portfolios, and maybe also what we do here at Merk? And as always, please type in your questions along the way. David will pick out the questions in the end, try to get to as many as possible. And so let me just go into this in the spirit of having very opposing views of what tariffs mean in general. And I intentionally used here a left-leaning and a right-leaning institution. And just to take it up front, odds are I'll offend most of you here along the way. My own political leanings are that I have pretty much some gripes with both the left and the right. And so if I start complaining about something, don't worry, I also have related complaints to the other side of the aisle. But let me start with this. And so the Brookings Institute, a left-leaning think tank, expressed the view that they're rather concerned about the retaliatory effects of tariffs. So overall, we got 48 billion announced, and this now doesn't talk about the Chinese tariffs. I'll talk about those separately. But this talks about the tariffs that were announced in the beginning, and obviously we have some updates on those. Just today, the European Union was also excluded from those tariffs, at least for now, and so that number might be is likely to go a little lower. But the Brookings Institute was very concerned about the retaliatory effect and saying, hey, there's going to be ripple effects from higher steel and aluminum imports, and overall it's a bad deal. Keep in mind that in previous administrations, when we've had a left-leaning or a Democrat as a president, the Brookings Institute, if I recall correctly, has been in favor sometimes of tariffs. And so some of that is political posturing. And so the exact same thing can be said for the Coalition for Prosperous America, which is a right-leaning conservative political advocacy group. And as you can see there are some quotes from them that this is ultimately a good thing for America. The point I'm trying to make here is that a lot of these things are seen through a political lens. And when it comes to anybody's investments, and that's kind of my focus here, my focus is not to say these guys are wrong or these guys are wrong, although I might throw some of those comments as well. But the point is really, should I address the tariffs or any other political wins in my investment allocation? And let me just, to kind of round this out here, how relevant are the tariffs? So the tariffs are 2% of GDP, maybe, that would have been effective. Everything were infected. Imports as a percent of GDP has been steadily rising. And so, or has been plateauing, maybe you can say, in recent years, but it's about 16%. And if you go to exports, it's about 12, 13% of GDP. And the reason why that's relevant is, of course, if you do have ripple effects, if you have an escalation of a trade war, then yes, potentially it could affect the economy, whereas it is, of course, possible to shrug it off. Hey, it's just the steel industry that is affected. The third chart here in this group is trade as a percent of GDP, which is about, that's imports plus exports, right? And that's 30%. Now, the way that we usually look at percent of GDP, that what's most commonly known, is that we say consumption as a percentage of GDP. So more than 2/3 of the economy is consumption. And so if you think about it from that point of view, well, is it really all that relevant if we disrupt trade? And imports is just a small percentage, and so should we really worry about those sort of things? And you can make various arguments. On a micro level, it certainly has an impact. If you listen to the CEO of steel companies, the US companies, well, some of them are happy. But if you trade in steel in the US, for example, well, you've got to be very concerned because of the erratic price moves you can have. And so if you have changes in policy, suddenly the price of steel might plunge, right? But see that the tariffs are eliminated again. Well, if you got inventory of steel, suddenly you're sitting on a huge loss. And so it makes planning more difficult. And obviously that might mean you might want to hedge your exposure and whatnot. But ultimately, what's good for business is you have visibility if you can plan. And of course, if you have a new policy come out every 5 minutes, that's kind of difficult. And so even when you're a business person, you might want to be able to plan ahead and see through that. And so clarity in policy is often better than if you have something bad, like a bad tax policy, a bad trade policy. Well, that is better than having a policy that's unpredictable, because at least tell me the rules, right? Tell me the rules, and we know how to deal with it and what to do with it. And going into this theme here of the politics, let me go here to the next slide, and let me quote here Martin Feldstein. He is a very well-known economist, has worked with the Republican Party in the past. And he wrote an editorial just a few days ago where he said, oh, these steel tariffs are really about China. And if you look at today's announcements, this was written before today's announcements, yes, it may well be about China. And it is because in intellectual technology transfers and so forth, the Chinese are not dealing fairly. And then he says, oh, because the steel tariffs are really done under the pretense or the chapter of national security, you can exempt your allies. And so the Chinese are going to be affected, the allies are not going to be affected. And as this is playing out, most notably today with the exemption of the European Union, that may even be the case. But I would like to point out that from the outset, Trump did not exclude the allies and said, oh, this is for everybody, right? And so there you have to ask yourself, well, is it just politics, or why is it that he's kicking his allies in front of the shin, right? Why is he doing that? And is this brilliant policy, or is it disruptive because you're only making enemies? And is somebody like Martin Feldstein maybe just writing these things so he can get a job in the administration, right? And so all of these things are going to raise a bunch of emotions. But again, does it matter something to your investments? And so here again, just using a cartoon, and by the way, this cartoon used to have Ben Bernanke in it, so we repurposed this cartoon a little bit and played the actors, but you get the idea of what we're getting at here. So, so let's look at whether politics matters or not. And here is the chart of the S&P 500. The starting point is a date that you might relate to. It's in March 2009. So we intentionally here showed the low of the S&P. This is for the total return index of the S&P, so with dividends reinvested, in the spring of 2009, where the S&P has relentlessly been going up. This is as of March 20th, so a few days ago. Doesn't reflect today's drop in the market yet. But if you look at a chart like this, and the point of showing this chart is that nothing matters, right? The market is going up and up and up, and it always goes up, and who cares, and policies don't matter. And so if you've been critical about any of these moves, and we are as guilty as any of these, yep, you might have missed out, right? You paid attention to politics. You paid attention to something other than buy, and buy the dip. And so who am I to tell you that, well, maybe you should pay attention to politics because it just might have an impact on the market. Well, let's dig a little bit deeper. And let's look here at the FANG index. So that's the index of the darlings with Facebook, Amazon, Netflix, and Google. And most notably, there's a drop here on the right-hand side. Again, this is, I just see that this has normalized as of December 31st, but this is as of March 20th as well. And again, it doesn't show the drop we had today in the markets. And so now I'm asking, is it because of politics, or is it because of something else that Facebook has been declining? And I think you can make a very good argument that it is that the recent kind of outcry on the data issues, while it probably is not a surprise to many, that it has been a catalyst and that something has changed. And one of the things I've argued is that with regard to Facebook, and I'm not making an investment recommendation here on Facebook, that it doesn't really matter whether Mark Zuckerberg is giving a sincere or a good apology or not. What matters is whether it is politically opportune to portray Silicon Valley, portray Facebook as the evildoer of being the ones responsible for the ills of the world. And I phrase that very generally because in the past it's been the bankers, recently it was Hollywood, now it is Silicon Valley. And my own take is that just as Trump has had some targets, be that the Mexicans, be that these guys or that group, North Korea being one of them. Well, I don't know yet whether Trump is going to make it as a target or the Democrats, but Facebook, social media are the perfect target for anybody who is populist. And I don't think that Mr. Trump is the only politician out there who is populist. I'll show you here a few slides in a second of a few others around the world. And so, does it have an impact on the markets? I would think it does. And if you again, if you look at today's drop of over 700 points in the S&P, I would think it does as well. And so, let's take a little broader look. And we had this chart we borrowed from the pre-Brexit chart, and next one as well, and wanted to just point out a few other populist movements in the world. And the top left is the Arab Spring. You got Greece, you got the independence movement in Spain. Obviously this was the pre-election, so we got Sanders on there as well. We got something in Ukraine. You got, and I put the Japanese Prime Minister Abe on the lower left here, and Putin. All of them are populists in their own ways. They express their populism differently. But what is also different is the robustness of the institutions and the structure of the economy. So in the US, for example, trade is a comparatively, especially imports, is a comparatively small part of the economy. Many economists talk about the US being a closed economy. Well, for a country like Sweden, not depicted here, exports is everything. Right? If they can't export, the country is toast. Right? So they're far more vulnerable to tensions on the trade side. Whereas I have the Arab Spring there, if you have a populist uprising, the institutions can't take it, and you have these countries fall apart. I argue that that in the Arab countries where you had the Arab Spring, it wasn't that they loved democracy. No, it was rising food and energy prices, so people couldn't feed themselves anymore, and so they revolted. And the institutions weren't strong enough to stomach it. Whereas in contrast, we have a populist president in the US, and we got institutions that are reasonably robust, so we can survive yet another tweet. Now, you can argue that it's harmful and whatnot, but I would think everybody agrees that we are better equipped to deal with somebody who is a populist leader in the US than the Arab region was, where you had the Arab Spring. Now, you can take the position that, hey, it doesn't matter. This was a Remain poster and says, hey, it doesn't really matter. And of course, there are some folks that said, all hell is going to break loose if Brexit happens. And guess what? The UK is still around. The sterling has recovered quite significantly. We think it's vulnerable at this level because they got this temporary deal. Things could still fall apart. But here again, I'm linking it to some price action. So I do think, yes, policy does matter. It's sometimes difficult to gauge how it's exactly going to play out. But real estate in the UK has, for example, been suffering. Growth in the UK has been lagging. And so I've been arguing that the deficits in the UK are going to increase quite substantially so, and the currency in the medium term is going to suffer from that. Well, in the short term, the currency has done quite well. But if anybody thinks that politics don't matter, well, let me remind you that we had Mr. Draghi promise whatever it takes, which had a huge, huge turnaround as far as politics is concerned. And so we can say, all right, in the US nothing matters, but I don't think I would go that far, right? Just as this small statement, I'll do whatever it takes, had a huge, huge impact. Mrs. Merkel there in the background had a huge influence with her austerity, that she's been kind of made the poster child at imposing that on a country like Greece. That does have a big, big impact. And by the way, just on German politics, the new coalition government has a finance minister who's no longer Schäuble. He's a social democrat, and he just affirmed that he is in favor of a balanced budget. Now, here you've got a left-leaning finance minister who is still wants to have a balanced budget. Very, very different policy from what we have in the US. And so let me take it here to a step further and go to the fiscal policy. Well, does fiscal policy matter? And we had a tax reform, and if you look at the reactions in the markets, we'll show a chart here in a second. Yes, the market did react initially to the tax reform and had various other things, but what we have is we have now a government that seems to be spending like there's no tomorrow, right? And if you recall, under the Obama administration, Republicans were kind of the deficit hawks. That seems to have been thrown out of the window. One of the things, by the way, I love is when there's gridlock in Congress or any other country. I mean, one of the great things about the German paralysis for half a year was that they couldn't spend much money. And so similarly, when you don't have an agreement in Congress, it's very difficult to get spending done. When you have the House, the Senate, and the White House with the same party, well, guess what? They're going to spend money the right way. And I say the right way is because your party is always the right way the money is spent. And if it's the other guys from the other party, they always say, oh my God, your spending priorities are absolutely the wrong ones. Each one of these bullet points increases spending. But here, let's get into these numbers here a little bit into detail. And you've probably seen a chart related to this one. The darker line here, the black line, is the 10-year yield until recently, and then the grayish line is the Trump approval rating. And the reason I show that is that when the Trump approval rating had been moving higher, there had been for a while a correlation. And even if you go to the lower lines, I don't know whether you can see my mouse move here, there has been a correlation, right? When Trump is effective, the 10-year had been going higher, and part of that was because of the tax reform. The tax reform all else equal, would stimulate longer-term growth. And so, and possibly more inflation. It's difficult to discern the two. But to the extent that it does that, it is warranted that the 10-year is higher. And so I do think that, yes, it is very appropriate to try to raise, to read the tea leaves and try to kind of gauge of what the impact might be on the market of any one policy. So let me take this a step further. And let's look at monetary policy, right? Does monetary policy matter? Does it matter for asset prices? And I would think most people would agree that, yep, hey, the money printing has helped to lift asset prices around the world. And of course, to take this kind of a step forward, the printing party may be over. The Federal Reserve hasn't been printing in a while. The European Central Bank is scheduled to phase out its printing later this year, either in September or in December. And there's a bunch of headlines out that maybe the ECB is going to start raising interest rates starting in Q2 of next year. And then, of course, Mr. Draghi is leaving the European Central Bank at the end of 2019. And so who are the winners and the losers in a trade war? And looking at it from a currency perspective, we can also talk about a little bit from an asset price perspective. And then I'm going to go a little bit more into the psychology of how we are affected in our investment decisions, and then maybe how we should be affected depending on the type of strategy that we do pursue. And so here, this is an old cartoon. Of course, we just use that as a placeholder. The question is, let's say we have a trade war, and let's say that there's an escalation and there's a tit for tat, and who is going to benefit and who is going to lose? Now, generally speaking, most economists would agree that overall economic activity is going to be lower in a trade war, that there is no winner. Now, when you think about the currencies, of course, it's always one currency versus another. And so, of course, there's one currency has to go up, one has to go down. In my experience and in my analysis, the countries with a current account deficit tend to suffer in a trade war. And so if you take the example I like to raise is Japan and New Zealand, but we can apply that to the UK, we can apply that to the Eurozone, we can apply that to the US as well. But the most pronounced examples tend to be Japan and New Zealand. In Japan, the more dysfunctional Japan has been in the past, the stronger the yen has been, and the more there has been a perception that there's growth, the weaker the yen has been. And so when there is a trade war, people are consuming less, potentially, and that means they're saving more. And if you don't need to finance your deficits from abroad, everything else equal, that is a positive for the currency. And we saw that after the earthquake several years ago in Japan. Now, just after Japan had its tsunami and earthquake, New Zealand had an earthquake as well. In New Zealand, whereas in Japan, the yen went up in the aftermath of the earthquake. In New Zealand, the currency plunged. Key difference is that New Zealand has very significant deficits, and even in the aftermath, well, people are investing less. And the rebuilding effort, then things change, but in the immediate aftermath, they're investing less. And the reason I mention that is because it's not always so obvious which currency is going to benefit and suffer. Now, clearly, if your country is the direct target of tariffs and you are vulnerable in that, that may well be overwhelming. So Mexico, for example, the Mexican peso had been very sensitive, and so that wasn't too surprising. But if you take the Eurozone, and that's kind of the biggest guy out there other than the US, when there's been talk of a trade war flaring up, the euro hasn't suffered from that. In fact, the euro has taken on ever more Japanese qualities. Now, you can say that's because of the negative interest rates, you can say that's because of some other structural things, but I can't help but observe that with all this talk of a trade war, the dollar has been weakening. And part of that may well be that, hey, the U.S. has a a current account deficit, and so everything else equal, maybe there is a downward pressure on the dollar when you start a trade war. And if I'm sorry for looking here on another screen, I have on another screen here a Bloomberg terminal, and I'm looking at the dollar, and the dollar is down versus all the major currencies, with the big exception of the yen today. I don't think that's terribly surprising. Now, you could say, hey, it's a risk-off day and the yen has to rise. Yes, but what about this flight to quality? Right? Historically, when we have this flight to quality, isn't the dollar rising? And the challenge here is that we get trained with correlations that may not be applicable anymore. In 2008, yes, that was the case. In 2008, there was a huge rush into treasuries, and the money was sucked out of emerging markets into treasuries, and the dollar was soaring. Well, the world is different now. When there's a crisis, the money doesn't flee into treasuries. And part of that may be related to the fears about trade, that people are not reallocating the money to the treasuries. And so that there are other safe havens. And a big driver, I do think, is the negative interest rates in the Eurozone. And the reason that is the case is that when the funding cost is lower in a currency, well, that means when risk is on, when people borrow money, they borrow where it's cheapest, which is the euro, which means that's building a short position, so to speak. And then when risk is off, then money is repatriated, and the dollar and that currency, in this case the euro, is benefiting from that. And yes, the euro is down today a little bit. And let me just see here. Yeah, no, sorry, I mixed this one up here. The dollar is up versus many of these currencies. Let me just see here, looking at a few things here. Anyway, let me move on here. So let me switch over here and talk about how one's psychology affects accepts investing. And the Financial Times had an excellent article. The URL is here in the bottom. And by the way, if you want to have copies of the slide, please drop us a note in the Q&A box, and if you can't copy down that URL that quickly, for example, you might want to have it. And the article, the Financial Times here, is arguing that we are social creatures, and we are driven by our tribal instincts. And so one of the things they say there is, the more college educated you are, the more you might be dropping into this tribal instinct. And that's a little bit counterintuitive, because anybody who's educated has been scoffing at those uneducated guys doing things, and then the educated ones are always doing the right things. Well, it's not the case. The Republicans and Democrats, if they're highly educated on either side, they actually tend to have the more extreme positions. And that means that if you don't like Trump, and if you're an intellectual, you might make an investment decision based on your disdain for the president. And conversely, if you love Trump, you might make an investment decision based on that. In fact, I have seen advisors have the Republican portfolio, for example. In fact, in recent years, I've seen investors more and more so construct portfolios based on their political convictions. And so it used to be that investors maximized profits, maximized returns when they constructed a portfolio. Now, but what happens when the markets go up and up and up and up? Well, it doesn't really matter what you invest in, right? And so you might as well invest it according to your social convictions. And by the way, social investing in the 1990s even was on the fringe, right? Oh my God, the tree hugger is investing in where to save the world. Whereas nowadays, the attitude has changed and saying, yeah, I'm not going to invest in tobacco. I'm going to invest in the folks who make the world a better place. And if everything goes up, it doesn't really matter, right? So you might as well invest according to the feel-good factor. Now, obviously, a lot of other things have changed. We want our companies nowadays to be socially responsible and whatnot. And so a lot of these things, and consumers are seeking out companies that do things that is according to their liking. And so you maybe, just maybe, investing in companies that are more socially attuned is a more profitable strategy. But I do like to caution that a strategy that has worked when the markets have been relentlessly going up may not necessarily work when volatility is going up and we got a greater dispersion of where things go. And how do you fight that, right? What do you do? How do you take care of that? The New York Times has an article, and here there is a link as well. A few weeks ago, or a little 10 days ago or so, where the New York Times wrote, well, how about you just turn off your phone? If you think about it, rather than getting every 5 seconds a news alert about the latest and greatest coming out of the administration, for 2 weeks, try to read a printed newspaper, if such things are still available in your neighborhood. What you're going to get is news that have been kind of, you got away from the noise, you get an analysis, and you get it the next day on your desk, and you'll be better informed potentially. And your stress level is much lower. Now, granted, of all newspapers, of course, hey, the New York Times has at times, like every day, been accused of having a political bias. And so have many other newspapers. So it's, of course, this isn't the quote-unquote solution. But the point still being is that you might want to think about it, hey, why not take a step back to be able to digest what this all means? So take the Martin Feldstein example, right? You get, are you getting concerned that the Trump administration makes enemies around the world? Or do you look through the noise and saying, hey, yeah, the Chinese have done some bad things, we might as well address that. And don't worry, it's not going to have too much of an impact. Well, let's take a look here, and let's look at portfolio construction here a little bit more specifically. And I'm mentioning there are obviously different investment strategies as well. One of the things that I have argued is that there are many investment strategies that can potentially be profitable. The most important thing is that an investor has an investment strategy. And while that may sound trivial, I'm sure many of us have done, or at least we know people who have veered away from their investment approach. And who can blame you when you hear the news every day and tells you, oh my God, the end of the world is coming because of this, or this must be fantastic news, and so forth. And so the folks who do technical analysis, here's the first one, and I'm not endorsing any style here, they're maybe least prone to that, although technical analysis has, of course, also been accused of, depends on how you read your chart and what horizon you look at. But still, political noise should not be affecting you when you do a technical analysis. Whereas, let's go through the other ones. Like if you have a rigid allocation, and I'm using a 60-40 portfolio here as a proxy to a rigid allocation, 60-40, of course, meaning 60% stocks, 40% bonds. Well, the only thing you should really be doing is you should periodically rebalance your portfolio. Now, I would like to point out that even here already, a lot of people haven't been doing the rebalancing, right? When your 60-40 portfolio has been going up in value because the equities have been outperforming, what you should be doing is you should be selling some stocks and buying more fixed income. I allege that a lot of investors haven't done that. And so now, and part of the reason is because what the hell do you do on the fixed income side when you've got no yield, right? And also, I've argued that on the fixed income side, many people have been chasing yield, which creates in that fixed income bucket really also a melange of risk assets, so that when your equities go down, your fixed income portfolio might also go down, and that may have been driven by price action, or because you might be euphoric because of some policy changes, or you might have said, hey, nothing bad can ever happen and markets always go up. That's a cynic statement, by the way, not a prediction. And so there's already a little bit that can go in there where you could be affected by political noise. If you have a risk parity strategy, so that's a strategy where you say, all right, I have multiple buckets of investments, and for simplicity's sake, let's make it equities and bonds again. And I want to have the same amount of risk. And historically, these strategies tend to use leverage on the fixed income side so that you have the same amount of risk there. Well, that should also not be driven by politics, except that if the measures of risk you're using are forward-looking ones and have a qualitative component where you can gauge that the risk can move higher. That said, there is assuming not everybody is in passive investing these days. And while by all means passive investing has been increasing over the years, the one thing that hasn't changed, you really have a lot more tools, low-cost tools these days to express your own opinion. Right? You've got thousands of ETFs these days. Well, if we're really passive, everybody would just have one ETF, which is the S&P 500, or maybe a world index, or whatever it might be. But you have, of course, a gazillion of different ETFs. And what that means is that you can be as active as anybody, right? Because you can choose to allocate to, I don't know, to Saving the World Project, to electric vehicles, or whatever it might be. And so when you are, though, let's take this a step further. If you are investing based on value, for example, well, part of your job as an investor is to read in between the lines. And by all means, future policy very much so affects what you're going to do in the future. And so you think, oh, there's going to be subsidy for the electric car industry, or the steel industry might be protected with tariffs, right? That may very well affect your investment allocation. And so there is a very good reason why you might want to take politics into account. And clearly the success of financial media suggests that people are very interested in the latest and greatest news. And if you look at just efficient market hypothesis, by all means, stocks are supposed to incorporate all the information that's available in the market, which means, of course, yes, if new information does become available, you reflect it in your asset allocation. I throw out there, just for food for thought, artificial intelligence. You have these days these algorithms that are trying to interpret the news. And so the question is whether the computer can understand Trump better than humans. Now, if you don't have an investment strategy, then by all means, odds are much, much higher that you will get influenced by the politics. And so I would urge anybody to say, yep, I gotta have an investment strategy, because I need to find out a way that I can kind of be affected by what's happening out there. Let me just use a word on gold here in the context of politics. And gold, of course, doesn't change. It doesn't change when you have political comments come out. But of course, the price of gold can be influenced. And why is it? Why is it that the price of gold is moving when you have political news as well? But because, of course, investors have a choice of what they buy. And so they might buy gold, they might buy equities, they might buy fixed income. The key difference between gold and many other assets is that gold does not have a cash flow. So when something does not have a cash flow, what it means is that when the discounting of that cash flow changes, well, these other assets are affected relative to gold. And so very specifically, if you have a so-called risk assets that has future cash flows that need to get discounted, well, when volatility rises or when interest rates rise, then the discounting of the future cash flow means that those risk assets tend to decrease in value, everything else being equal. Whereas because gold does not have a cash flow, when volatility rises, gold historically does well. Now, I've been asked many times in the past about, well, there is some terror attack, for example, that happens in the world, and nowadays markets are reasonably immune to those, but historically, I often get asked, well, price of gold is jumping. Should you buy gold because there is an attack in the Middle East, there is this happening or that happening? And I tend to be, my answer is usually a cautious one in saying, well, if there is something that's likely to be temporary, then that short-term spike in volatility, well, it's going to abate again, right? And then so the price of gold might be rushing up, and then it might plunge right back down. Also, as we've seen, the markets get used to certain things. So if you have the same thing happening over and over again, and that might unfortunately include terror attacks, then the markets are kind of getting immune to that, and then the volatility is not going to rise as much. And so that's partly what we saw. I would allege that much more so than a series of terror attacks, it's been of course, QE that kept volatility down. Now, all that said, we've now had volatility be very, very low for an extended period. And so what happens then at the other end of the spectrum is that as volatility is going to move higher and might be higher for an extended period, then yeah, you might get greater discounting going forward. And we see that obviously with risk assets being suffering. I do believe, if I get this correctly, the S&P is now down year to date, right? And so question is, of course, what's going to happen going forward. But if you have a policy uncertainty about China, right, the next thing that's going to happen is, well, hey, what's the next thing? How are the Chinese going to react? And so let me go into that here a little bit. There's a lot of talk about how the Chinese might retaliate with tariffs on soybeans, for example, the sort of things where there are substitutes, although the US is the biggest producer and it's going to be difficult to find substitutes. And by the way, if you want to have a trade war, it's probably good to do that in a good economy than rather when you're in a recession already, so you can take that hit if you think it's worth the long-term gain. I happen to think that the far more likely scenario is that if you're an American company and you want to get a license to do business, well, maybe, just maybe, it's going to take a little bit longer to get that license. The Chinese bureaucrats are going to make your life more difficult. And so, sure, they might announce something so that for the headlines, they've done some tit for tat. But I think overall, life might get more difficult for corporate America. Or, for example, in the announcement today on the Chinese tariffs, I don't think the specifics have been announced, but I'm looking at my notes here. I think there have been some general comments of the industries that may be affected. And one of the industries that is supposed to be affected is aviation. Well, guess what? The Chinese are quite likely then to buy more planes from Airbus rather than from Boeing. Right, and it's those little things that you don't need to have a policy necessarily to see that they're suffering. And of course, how do you translate that then to policies or to investments? Well, the easiest is you sell risk assets, right? And so it's one of the reasons the S&P is likely down is because you have this uncertainty. You don't know what it's going to affect specifically. The worst sector, by the way, today in today's market is the financial services. Now, there could be several reasons. One is, hey, financial services have been immune to recent price declines. For example, in the price declines we've had earlier this year, financial services have done great. So it's their turn to suffer. One is, hey, bonds were rallying today. The long bond, the 30-year, was up over a full point. And so that's historically bad for financial services. It's good for utilities. Utilities was the best performing sector today. But you can also link it to trade and saying, hey, all of trade has been very good to financial services. And now if we have a trade war, well, there's going to be less M&A activity. There's going to be less hedging activity. There's going to be less this and this and this. And so if you read the newspaper tomorrow, or if you look at your live coverage on your screen, pick the story. It's difficult to assign those things. So you can, again, shrug your shoulders and say, hey, it has nothing to do with these things. But I do think that, yes, when the markets do react to a news announcement very quickly, then there is quite likely a reaction. Before we go to the Q&A, let me make a few general comments. And first of all, I talked about the markets a little bit. I showed earlier this chart about the S&P 500. What I wanted to mention there is we started a series that we publish, a research series, and that research series, we go through a bunch of metrics on the S&P 500. Historically, what has created bull markets and bear markets, and we try to be as unbiased as possible in that. So when I talk in these webinars, I very clearly express my opinion. And I, as you might gauge, is I am concerned about risk assets, and I can talk about that more broadly, and please ask questions about that. But in that video series, we try to go through a very consistent metrics, and based on those, say, hey, what are the odds of a bear market? Based on that methodology, there are various investment strategies based on that. And we have that. We sent this out now only to the folks who engaged a few months ago when we started that. We have another series on the business cycle and so forth. We have that on our YouTube channel. And so if you want to get that, you can subscribe to that on our YouTube channel. If you go to youtube.com and put in Merk Investments, you'll see that. You can drop a note here in the box, and we'll add you to the list. We have now started to host these things on our website. They're not directly accessible from the homepage, but we'll send you both the video and the chart deck. Some prefer one versus the other. And so that is something that if you want to have access to those, you can have it. I show you on the screen our products. We do not, this is not a product session here, so this is mostly a placeholder. But if you have a question about products, you can of course mention. You can put in a question, and we'll get back to you. We do a few things, more things than the products these days. We do provide some institutional services. We do some risk analysis on portfolios as well. And we are thinking about providing services to certain people who have special requests, and I don't really want to go into that too much, but if you have a need, if you have a desire as a professional investor or as a retail investor, let us know what your desire is and what your need is, and we'll see whether we'll get back to you of whether we can help you. So with that said, I know I stayed quite on a high level. Let me pass it back here to David and to manage the Q&A. I've seen we've had some questions come in, and then talk some more specifics. Go ahead, David.
Great, thanks, Axel. Please now take a few minutes to read the following disclosures as we move to the Q&A portion of the call. Again, I would just like to remind everyone that you can ask a question by typing it into your text box. And our first question comes from George, and he asks, it looks as though future tariffs on China are targeted to companies infringing on American IP. Do you think that this will offset the positive effect the addition of China A shares to the MSCI Emerging Markets Index might have on Chinese ETFs? Axel?
All right. Yeah, it's a long question. By the way, I also thought about something else here briefly. I made a mistake earlier. I mentioned today that the dollar declined. I believe that, of course, is not the case. I mentioned that because we had a little dip up in the euro in between. But generally speaking, the euro has often gone up now in risk-off days. And of course, the strongest performer in today's market was the yen. And so I'm trying to read this question here. I see it here on the screen as well. I'm trying to figure out how to best address this question. The China ETFs in general were down today. And the question here is, of course, the tariffs that are being imposed are, of course, not imposed directly on any IP or anything. It's imposed on China, right? They're trying to bring China to its knees. And China, of course, is proud these days, right? And China has found that they can recover from any crisis quite quickly by just increasing some infrastructure spending. Now, that said, Bill Gross said earlier today that if we look at how leveraged economies are, well, the Chinese economy is more levered than the US economy. And so if we're going to have a fight, and if it's going to affect economies negatively, the Chinese are going to be affected more than the US. I mentioned also the US is a fairly closed economy. And so while China has some levers, yes, China is vulnerable. And yeah, if you want to bully China, this might as well be a time that when you may want to do it. Now, I'm not going to predict how exactly it's going to play out. The one thing I didn't mention earlier, and let me maybe expand on that, is what do I do maybe personally? We got our products and they have the investment strategies, and I don't want to comment on that in this webinar. For that, by the way, as David mentioned, I believe April 18, David, correct me if that's wrong, we have our quarter webinar there. We talk specifically about our funds. But the way I look at investing is I've always said, all right, let's look at the world in terms of risk scenarios, different probabilities. In fact, I wrote my master's thesis on that, and I've really always stuck to that framework. Was quite a few years ago that I did that. But basically, here's the world, and yes, this is the likely scenario, but these are all these other scenarios. And the question is, do you put all your eggs into the most likely scenario? Or do you try to distribute your eggs in a way that you can account for different scenarios as well? Now, of course, you don't want to get completely paralyzed, and taking a view, I think, is a good thing, but you always want to kind of look at the different risks. And so one of the things we do here at Merk is we try to stress test our views. And so when we have a new idea, we look at, well, how it has historically performed. Well, guess what, right? If you have 9 years of a bull market, it's kind of a one-way street. It's a little oversimplification, but you can kind of take out different periods, right? During these different risk-off periods that we've had, how has something performed? So that is one way you can do it. Now, problems, of course, even the risk-off periods might have had different characters. And let me just expand on that. I know I'm moving on here from the question. But for example, in early 2016, when we had the severe downdraft in the market, it was because of the stress in the oil sector, right? MLPs were all in the news because the kind of the fracking industry was under pressure. Access to financing was drying up. The so-called financial conditions were deteriorating. Well, guess what? The Fed freaked out. That's my interpretation, maybe an exaggeration. But what happened in early 2016 is that financial conditions were driving the S&P 500, and very much so there was a very high correlation to Fed policy, which then ultimately affects asset prices. What is different now is that we have Facebook in the news, and a company like Facebook does not depend on access to the credit markets. So you can have the price of Facebook plunge, but the Federal Reserve is not going to change its policy because access to credit isn't changing. And so if you look at the access to credit, the tightening financial conditions, that used to be a one-in-one correlation for many years after the financial crisis. And we've gotten used to this idea that when the market plunge down, the plunge protection team from the Fed comes in and comes to the rescue. Well, that is no longer the case, at least for the time being. We have to watch those things. Now, what about regard to trade, right? There is access to credit being restrained, or can monetary policy fix fiscal policy? And in many ways, it cannot. But you might have less tightening in the markets as if certain things happen. And the reason I'm looking here over to the side is I'm looking at my Bloomberg screen, and yes, the amount of tightening being priced in is significantly lower today than it was yesterday. And by all means, the tariffs may very well have had an influence on that, they're saying, hey, wait a second, if we do have tariffs, maybe it is going to cause an economic slowdown, and maybe we're going to be tightening rates much, much less. David, back to you.
Okay, our next question comes from Patty. And the question is, what do you think the outlook is on the US dollar? Axel?
Outlook on the dollar. Well, for 4 years, the dollar was rising. And then for a year and a half or a year and a quarter or so now, the dollar has been falling. And in recent weeks, it hasn't done all that much. And so we've currently quite a bit of speculative positioning that the dollar is weakening, notably versus the euro. And so a lot of people are saying, hey, it's due for a snapback, it's due for a rally. If you look at the market yesterday, for example, the dollar was rallying quite strongly. We've given up some of these gains today, so that's in the very short term. A lot of it is driven by what's happening in Europe these days. And people are pointing out these rate differentials have been getting very large, yet the dollar has been weakening. Well, something similar happened, of course, with the US when the dollar was rising year after year after year. The Fed hadn't been rising rates for a very, very long time. That's only a more recent thing. And so instead what's happened is that it's this expectation of a rate hike. And so similarly, in the Eurozone, we're not hiking rates. But what's happening is that there's this expectation that something is changing. There's expectation there's going to be tighter, expectation that economy is doing well. And sure, Draghi is pouring cold water on that notion. But I would allege, and I would think many people agree, that for Germany at least, the rates are too low in Europe. And so who knows who the next ECB head is going to be. It's Germany's term. We've never had an ECB head from Germany. Now, I'd like to throw out here that I actually don't think it's going to be Weidmann necessarily. I happen to think it might be a kind of the second in command in Germany at the Bundesbank or somebody like that, who there's a woman who is a lawyer. Well, guess what? We have a Fed chair who is a lawyer. The new generation of people running central banks may well be lawyers. And in the Eurozone's case, it may be that that's a compromise candidate, because if you have someone like Whiteman, going to be just too hawkish to push through, and the Germany has said, for example, the price might be too high to pay, meaning that France and other countries might then insist that, well, if you get Whiteman, we need to have a European finance minister, and we need to have a European budget. And guess what then? All this austerity we're imposing on these other countries may not happen anymore. So Merkel might want to have the flexibility. So we'll have to see how that plays out. But with regard to how the dollar is going to move, I mentioned earlier, in a trade war, I happen to think that the yen can do very well. I happen to think the dollar is not going to be the winner in a trade war. With regard to the immediate trading partners that are so extremely dependent on the US, it may, of course, have an impact. Now, but keep in mind that a lot of what we hear from the administration is noise, right? We hear so much noise from the Trump administration, so who knows what's going to come in earnest. Now, we also know that the balancing forces in the White House are diminishing, right? Cohen is out. And so the folks who are listening to Trump or talking to Trump share his views on protectionism. And also, let's keep in mind, we have seen in the sentiment around the country that it seems that Democrats are going to gain votes in the House in the midterm elections, potentially significantly so, which means that it's going to get more difficult to get things done in Congress. Well, what do you think President Trump is going to do when he's not going to be able to do things in Congress? Well, the same thing that Obama did. He is going to rule by decree, and Trump has already shown that he can do that. Now, what's the better target than doing it on trade? It plays very well to the base. It makes wonderful headlines. And obviously that's the one area where he has very strong views. He might get things done. He can, quote unquote, protect the American worker by throwing more tariffs on the bad guys abroad. And in that sense, by the way, I'm not so convinced that the European Union is not going to be hit by tariffs at some point, partially because Merkel in particular stands for everything that Trump doesn't stand for. And if there are no moderating voices, I can very easily see how a trade war could come from that. And so then the question is, well, what happens to something like emerging market currencies? And if I look here at my screen today, emerging market currencies some of them have moved quite a bit. The Mexican peso is down over 1% today, Brazilian real, those are affected by trade. But several other emerging market currencies haven't done so poorly. By the way, the Chinese yuan is down 0.5% today. And I like to point out the renminbi has had quite a run, has done very well of late. And so is it profit-taking or is it the trade war? Remains to be seen. But the emerging market currencies, what they have more is they tend to be more correlated with risk assets, because when you have a risk-off period, then there's a sucking out of money from these countries. And part of the reason that happens is that you cannot easily hedge your currency exposure when you invest in emerging market currencies. And the reason I say that is because it's very expensive. These tend to be high-yielding currencies, and if you quote-unquote hedge your exposure, it's going to cost you an arm and a leg. And so a lot of people don't hedge it, but rather pull their money out when the tide is turning. Back to you, David.
Okay, and our last question comes from Henry, and he asks, how long will this uptrend in stocks last? Axel?
I think it's over. Well, several answers. First, by all means, do look at the research service that we have. Drop a note if you want to be put to that list. Go to a YouTube channel at Merk Investments, type that in. That gives you some statistics, and based on some metrics, we are long in the tooth on this bull market. There are other metrics, though, that suggest this bull market will continue. Now, that is based on those metrics that are supposed to be unbiased. Now, I am biased, and I am, as I indicated, look at this world in terms of risk scenarios. And if I look at what's happening around, I think there are lots of reasons why we may have seen the peak in the market. And the most recent example is Facebook. And again, I'm not giving a specific investment recommendation on any one stock, but we have seen this playbook before, that there's a company-specific problem, and maybe we shrug it off, maybe we should not shrug it off, but especially this Facebook story, in my view, is going to snowball, right? We already have politicians around the world say that we need more regulation. If you are a populist politician, why not drag the CEO of Facebook in front of Congress, right? You want to have a show, and everybody's going to be watching when Mark Zuckerberg has to testify in Congress. And so there are incentives in the system to keep this going. And by the way, you're going to have more regulations. And we don't have a coherent framework in the US on privacy. The Chinese have it, meaning they don't have privacy. The Europeans have a very rigid framework, and they're going to complain that rules have been violated. In the US, we don't have it, which means we're going to have the same thing as with any other policy. We're going to have a lot of bickering. We're going to introduce a bunch of regulations. In the end, the consumers is probably going to be no worse off. But what's going to happen is something similar that may well have happened to Microsoft. That's at least my view, is that there's going to be a lot of distraction to the management, and that may not be good for the stock. Now, again, I'm not giving an investment recommendation on Facebook, because it is not just Facebook. It is all of social media. It is all of Silicon Valley. Well, guess what? The market leaders have been the Silicon Valley type of companies. And then it's going to say, oh, it's only those Silicon Valley companies. And again, the same thing is going to happen. If you look at 2000, there was nobody around in March of 2000 said this is the market top. Indeed, as late as September 2000, a lot of people still said, this is temporary, buy the dip, do this and that. And sure enough, the buy the dip mentality is not going to just evaporate here overnight. And so, yeah, when we're down 20%, somebody will say, hey, yeah, we're in a bear market. Are we on that trend yet? I think the odds of that are reasonably high. But it comes back down to follow your investment process, right? If your investment process is technical analysis, it doesn't matter what my opinion is. If your investment process is different, well, maybe it does. And to me, the question is more, and what you might want to ask is, what is the risk that I am right? Is your investment portfolio properly connected? And by the way, the time to take chips off the table is when risk assets are high, so that you then have the ammunition to go down. And to just say that as a closing word, for most investors, the S&P is not the benchmark. It is anyone's clients' investment goals, right? And the question is, how can you reach that? And trying to time the top is very difficult. Now, of course, if you took the chips off the table several years ago, you quote unquote missed out on a rally for quite a while. But it shouldn't matter. It shouldn't matter whether that was in the context of anyone's investment mandate. So with that, I give it back to you, David.
Great, thank you, Axel. And that concludes the Q&A portion of the call. If we weren't able to get to your question today, we will get back to you via email. Should you have any additional questions or comments would like a copy of the presentation slides, please use the Contact Us section of the website at www.merkinvestments.com. Also, for future webinars, if there is a topic that you're particularly interested in and would like us to cover, please let us know through the comments box. This concludes our call. Have a great day.